Hello, everybody. My name is Stefan Reichelstein, and it's my pleasure to provide this academic spotlight on the topic of assessing corporate and product carbon footprints. The motivation for this is really quite simple. We're observing a number of multinational firms really getting into a higher gear on their own in-house carbon accounting systems. And that's what I want to really focus on in today's presentation. Why are companies really shifting into a higher gear when it comes to corporate carbon accounting? You see here on this slide a number of factors that I think have contributed to this recent movement. Most importantly, and among those, probably what has been happening from the regulatory side, in Britain early on in 2013, then the European Union, California, all still in the phase where they are ultimately determining what companies should report about their corporate carbon footprint. We have also seen recently developments where companies are being asked to report on the carbon footprint of individual sales products. That will be important if goods and services are being imported into the European Union starting in 2026. More broadly, beyond those regulatory requirements, there's also an increasing need for providing various stakeholders with reliable emissions information. Concerns about greenwashing keep coming up. And so the whole notion is, can we design and build ultimately corporate carbon accounting systems that really provide us with more reliable information and allow management at the end of the day to steer the overall decarbonization efforts of their company? This slide here produces a chart that you've probably seen on various occasions. It's nothing more than an illustration of the greenhouse gas protocol, which provides de facto in today's world a framework for reporting carbon emissions at the company level. You see in particular the distinction between upstream and downstream emissions, as well as the different scopes of these emissions. Now, while this is commonly practiced, there is, in my view, widespread concern that this implementation is not yet what it could be or should be. Various academic studies have shown that the reporting is somewhat inconsistent, incomplete across different industries. Critics have also pointed out, in my mind correctly, that the greenhouse gas protocol in its classification does not properly distinguish between stock and flow variables, something that we would expect a good accounting system to do. And finally, the concern that is perhaps the most major one, the biggest in all of these, is the question, to what extent are we really are companies actually capturing at the end of the day actual emissions, as opposed to proxy measures based in secondary data? So before I sort of roll this up in terms of how this could all be done a bit better and a bit more faithful in the overall, according to the overall goals of the greenhouse gas protocol, on this slide, I was simply summarizing what, from a normative perspective, what standards do we really have for a corporate carbon accounting system? What should it enable companies to do? Well, first of all, you see on among the different bullet points here, the first one, being able to report on your actual periodic scope 1, 2, and upstream scope 3 emissions is something that this accounting system should do. We should also be in a position to assess the PCFs, the product carbon footprints of individual product. From there, we should be in a position to measure and provide a metric for the overall corporate carbon footprint, abbreviated as CCF here. And I'll refer to this later on as a company's net CO2 contribution. Finally, to maintain consistency across different accounting periods, it would be important to have the stock variables of this accounting system recorded on a CO2 balance sheet. And here you should think very much of something in analogy to a financial balance sheet. Finally, the whole issue of receiving assurance and auditing also must come in at some point. In other words, the workings and the information produced by this accounting system should be auditable. So in terms of getting this to work, I've produced here on this next chart basically a little pictorial illustration. Look at the company in the middle in the orange box called company. And company here receives inputs from its suppliers in the blue boxes. It also produces its own direct emissions in the as part of its operations. And the gray arrows there that you see, the arrows that are coming in from our suppliers, think of those as carbon tags. Some companies refer to them now as digital passports that represent the product carbon footprint of those inputs. And those have been determined at an earlier stage by the suppliers. And the whole thing then basically working backward or sequentially has started at the very beginning of the supply chain. So the important thing is that everybody along these supply chains does their part. In particular, the company in question operates its own product carbon accounting system to assign PCFs to all its sales products. So here now we're going down to the yellow boxes. And that is ultimately the information that the product carbon accounting system, as part of the overall accounting system, delivers. When we take this all the way down to the very end, to the customer products, we can, of course, also add the emissions that would be produced in the use phase. Those we can only estimate because they haven't occurred yet. But one could do that in order really to get from a cradle to grave product carbon footprint all the way, taking what has already been incurred and an estimate about what will be incurred in the use phase of a product. But for the purposes of the accounting system, the critical thing here is that we're focusing on cradle to gate DCFs. In other words, when the company sells its products and sales, it only reports on the emissions that have been incurred thus far, either by itself or its upstream suppliers. Now, once such a product carbon footprint system is in place, it's relatively straightforward now to get to the question, what does the corporate carbon footprint look like? And I refer to this here as the net CO2 contribution. If you look over on the left on the panel A, basically all we're doing is adding up the carbon footprints of different product lines. And we may add to it a category that I call general and administrative emissions. So this could represent items, for instance, like business travel, where the greenhouse gas protocol or other standard setters have said that should really not be assigned directly to individual product because it is not sufficiently attributable. So that gives us a measure of the periodic emissions that have been incurred in a particular time period. What we could subtract from it are eligible carbon credits. In this case, I represent those as removals in the green box. So think of the company itself or one of its contractors having removed so many tons of CO2. All that gets us a net CO2 contribution metric. And I submit this is a measure of the scope 1, 2, and upstream emissions contributed to the atmosphere by the business in the current period. That is, of course, something that the Greenhouse Gas Protocol asks companies to do. What the Greenhouse Gas Protocol doesn't do presently is really tell companies how to arrive at this periodic emission. From there, it's then in the next step, relatively straightforward to say, okay, if certain emissions that have arrived at the company's gates in a particular period have not yet made it through this net CO2 contribution measure, this income measure, if you want to, then we should really record these emissions on the balance sheet so as to have a proper separation between stocks and flows. And that's what you see here on this next slide. On the left-hand side are the emissions embodied in production assets of the firm that have been incurred and are going to make it into future contribution statements. On the right-hand side of this balance sheet, and it is balanced, you have both the direct emissions, the direct removals, what has come in the past, as well as the final account called legacy CO2 emissions here. And that really, by its very nature, represents past net CO2 contributions. So it's a little, or it's actually rather similar to the way we account for equity on a financial balance sheet, in that equity is basically original paid-in capital plus retained earnings from past period. What is all of this good for? Well, we want to be able, companies want to be able, analysts want to be able to do a CO2 statement analysis. In particular, we want to be able to answer the questions that are listed here in 4 bullet points. Is the business itself decarbonizing its operations? Are we reducing our scope 1, 2, and upstream 3 emissions? Are we staying within a certain carbon budget, or are we even eliminating our legacy emissions? Companies like Google and Microsoft have aspirations to eliminate their legacy emissions by the year 2050. And we can also do this at the product level now in terms of relating really the emissions attributed to an individual product to the overall corporate carbon footprint. So for all of these questions, our CO2 statement, the combination of the net contribution statement and the balance sheet, would really deliver the metrics by which we could gauge progress in these dimensions. Now, all of this is, in my mind, an architecture that might allow us a fuller and unified implementation, really, of the greenhouse gas protocol. And I think that would be significant progress. Let's see what you see as my conclusion here on this final slide. There are, however, still a few things to be filled in. Specific accounting rules, in particular around issues like the allocations of overhead emissions, are to be chosen. In certain industries, companies have already come forward, or consortia of companies have come forward and have written such rule books. So in my mind, it is perfectly possible that a company would disclose that it has followed a particular rule book, but implemented the architecture described here. Software integration of such a system, of course, is a necessary step for a company of any size. But you have heard in other talks already that this is really happening as we speak. From an auditing perspective, all of this also ought to be a lot easier, a system of double entry bookkeeping for carbon emissions. And a structure, as I've laid out here, ought to be easier to assure for an audit company. Thank you so much.